People are saying the world is ending and they feel depressed, and then they're going out and spending like there's no tomorrow. And the question is, how does that resolve? I would not be surprised that at the end of the year we're up 7 and 9% on the S&P 500. If we overshoot, looking at some of these historic breadth indicators, the Zweig breadth indicator has triggered, maybe we'll be up low double digits, 10, 11, 12%, but there's still tremendous opportunities.
Can the stock markets continue their momentum? Is this the beginning of the end of a bear market, or are we still in a bear market rather? We'll find out with our next guest, Thomas Hayes, managing member of Great Hill Capital. Thomas, it's always great to get a hedge fund manager's perspective on what's happening in the markets. Welcome back to the show. Good to see you.
Thanks for having me, David. Good to be here.
Last time you were on the show was in January. So, wow, time flies. We got to get you on the show more often. Apologies for not following up sooner, but time just flew. So lots happened in the last couple months, which probably was why time flew by so quickly. Let's evaluate what you told me earlier in the year. You had told me that, people should watch the full-length interview down below, but I think in the beginning of the year, you were a little more cautious in 2025 than you were, let's say, the same period in 2024, last year when you were on my show a year ago. So have things played out the way you expected to so far? Anything caught you off by surprise? Obviously, the magnitude of the tariffs caught a lot of fund managers off, but where were you and in terms of positioning on April 1st, April 2nd?
Yeah, I think, look, in early February and March, we were on public networks talking about time to buckle up, Buttercup. We're going to get some volatility. I thought we would get an 8 to 10% seasonal pullback, certainly some tariff uncertainty and that type of thing. Did I expect a 19% peak to trough drawdown on the S&P? No, but it was really an unbelievable blessing in disguise. It was certainly a man-made correction. But, one of the themes that I said in the beginning of the year, despite, to your point, we were certainly more cautious and less sanguine for 2025 than we were in 2024. I did say that our expectations were basically mid to high single-digit returns for the S&P 500, which was considered bearish at the turn of the year, by the way. Everyone was so juiced up on 2024 returns, and we're like, more subdued. And oddly enough, David, I think that's going to be on track. I would not be surprised that at the end of the year, we're up, 7 and 9% on the S&P 500. If we overshoot, looking at some of these historic breadth indicators, the Zweig breadth indicator has triggered, maybe we'll be up low double digits, 10, 11, 12%. But it's meaningfully up from here. And if you look at the average stock relative to the S&P, there's still tremendous opportunities and great things to do in this environment. But I think the key theme, David, is welcome to Trump 2.0, same as Trump 1.0. Tweet volatility resolves to the upside over time. And looking at that analog, which we were considering two during this drawdown, one was the 2018 Trump trade war 1.0, where you had a 20% correction really quickly and the market resolved to new highs within 4 months. And then we were also looking at a longer, more drawn out scenario of 2011, the European debt crisis, 20% correction, took 8 months to resolve to new highs. So we'll see which one this is. Right now, it's leaning closer to the 2018 with a higher upside, but we're going to need some more pauses in tariffs, and we do have a lot of businesses on hold waiting for more clarity. So that's not a constructive thing in the short term.
Okay, let's talk about tariffs first, and then we'll revisit your S&P 500 call that you just made. So here's from Bloomberg. Trump suggests some trade deals may come as early as this week. It could very well be, Trump told reporters on Sunday. When asked whether any trade agreements were coming this week, he didn't specify any countries. We're negotiating with many countries, but at the end of this, I'll set my own deals because I set the deal. They don't set the deal. You kept asking the same question. When will you agree? It's up to me. It's not up to them. I suppose he doesn't mean China. There's still 145% tariff on China, I believe. But anyway, I'll let you evaluate what's going on.
Yeah, look, I think the number one thing that the market needed to see, and I have to say, this was a strange correction because I had more peers, colleagues, money managers calling me in abject fear than I've ever seen in a correction. And I had clients calling me because they know these are the periods that I thrive, calling me and asking me how they could send more money in to take advantage of the opportunities. And many of them did. So very interesting scenario, and consistent with what you saw in the stats, that hedge funds and CTAs were record sellers of equities, over $1 trillion at the absolute low in early April. Apparently, they were not on Truth Social when President Trump said now is a good time to buy, because that marked the low in the stock market. So the problem with that is that these quote unquote investors have been praying for a retest of the lows, and praying rarely works in investing. So every single tape bomb of a deal with India, or a deal with Japan, or a deal with some tiny island nation, whatever it happens to be, they are going to be forced mechanical buyers. They are upside down, and now they're just trying to stem the bleeding and the redemptions from missing, not only selling at the wrong time, but more importantly, missing the opportunity to buy at the right time. And if you look at what's happened with earnings, I mean, yes, it's rear view mirror, but with 80% of the companies reporting, you have 12.8% earnings growth compared to 6% that was expected. And estimates, yes, they've come down a little bit for 2024. They've come down about 3.5% year to date, but they bottomed about a week and a half ago at 265 for 2025 on the S&P. They're now up to 266, which tells you guidance is actually starting to improve. And for 2026, estimates have held in. So we've got a lot of back-end loaded earnings at 302, which implies an 18.5 times multiple, which is not crazy compared to a 10-year average of 18.3 times. So that's kind of where I'm thinking. The other thought that I have on tariffs, David, is that I think you wind up with a net 10% across the board, which is $300 to $400 billion. Which is great from a refinance the debt standpoint, bring down rate standpoint, spur the housing market standpoint, and improve the cost of living standpoint. That, coupled with low gas prices and a lot of other things, are a good formula. Now, if we start to see Navarro on TV every day, then we could have problems. But so far, they've kept him in the closet, and it's been mostly Bessent and a little bit of Lutnick here and there. And I think Trump is showing a lot of flexibility and rationality, which the market was unclear whether that was going to be coming following Liberation Day.
You said to Reuters, and I'll pull up this quote from actually your website, Hedge Fund Tips. You extracted this. I do think that what today is saying is that the economy is a lot stronger than what people thought, and a lot more resilient in the face of all these tariffs and fears about tariffs. Which signals or indicators signal to you resilience, Thomas?
I think earnings and guidance are the name of the game. I think when you look at the negative GDP print, I think that was a good wake-up call for the administration. The bad news is you got a negative GDP print, and like 2022, if you get 2 quarters in a row of negative GDP prints, you have a technical recession. And I believe we had a recession in 2022, even though the council did not define it as such. All the activity and all of the results were consistent with the recession. So I think it was a wake-up call like, hey, you are threading this needle. You're trying to cut this money on Doge. You're trying to balance the budget, et cetera. If you tip into a recession, it's going to cost you way more to bring us out of a recession in terms of lost revenue, in terms of stimulus, than it would be to just do nothing. So your Doge cuts will be in vain. All of the fiscal constraints and layoffs will have been in vain if you tip into recession. So while the negative 30 basis points print for Q1 GDP was not the clearest, because if you back out the inventory building and the reduction of government spending, you're at plus 3% GDP. So it's not what you would normally see in a negative print. It still is a negative print. And I can assure you the administration does not want to see two consecutive quarters of negative prints, because that is a technical recession and that creates all kinds of problems. So they immediately did an about face. They, paused the tariffs, showed flexibility with the auto industry, showed flexibility with negotiating deals with counterparties. So I think in that sense, it was a wake-up call. I think they're going to wind up with it will look like they're blinking on these deals, but at the end of the day, they're going to wind up with $300 to $400 billion of tariff revenue. And if they had started with a 10% ask, we'd be lucky if we got 30 or 40. So they asked for the world. They wound up with something bigger than anyone could have ever imagined. And it keeps the train on the tracks. It doesn't, the light at the end of the tunnel is not an oncoming train, which people were worried about in early April. It's actually the end of the tunnel.
What are you expecting consumer sentiment or consumer demand to do for the next quarter? I'll give you some examples. So earlier in the year, we had data come in that advanced retail sales continued to grind higher. A lot of that came from actually trucks and cars, new and old. People were just buying them before the new tariff prices kicked in. Do you expect that trend to continue? Do you expect strength to continue at all?
I do. I think, look, you never bet against the U.S. consumer when they have a job. And we saw the jobs report. We saw the unemployment rate stay at 4.2%. Non-farm payrolls came in better than expected. There's an interesting dichotomy right now between the hard data and the soft data, what people say they feel and what they actually do. People are saying the world is ending and they feel depressed, and then they're going out and spending like there's no tomorrow. And the question is, how does that resolve? Does their sentiment start to improve consistent with their actions as more deals are announced? Or does their actions start to catch up to their sentiment, which is what the bears are worried about if this thing drags out longer? There was someone on Twitter today saying the next step should be a 180-day pause. Maybe we'll see something like that if they don't get a deal announced this week. But I think that now the American public is seeing some rationality and not rigidity on behalf of the administration. We're going to get more than we would have gotten, but we're not going to blow up the world to do it and create a depression or a recession. I think people's sentiment will improve. And the thing about the cars, it's a lot of different things coming together at once. Number one, dealer incentives are going up. I know this industry like the back of my hand because our largest position is an auto parts supplier, which I've talked to your audience about, called Cooper Standard, which was up 43% on Friday and probably another few percent today. They supply the sealing systems around the windows and doors and the fluid transfer systems for new automobiles, predominantly to U.S. OEMs. And the big deal there, what we've been watching, it's a play on the volume recovery, which troughed at 15.2 million SAR. We expect it to get to normalized levels like it has every cycle for the last 40 years of 17.5 to 18 million SAR. They make money on that volume. There are a couple of things. First and foremost is the average car on the road is 13.5 years. So yeah, they're going to continue to buy. Number two, dealer incentives are going up. They had this cartel during COVID that they really took advantage of people selling above MSRP, and they kept that game going afterwards, saying our supply is limited, our supply is limited. And that gig is up. So now it's going to be a race to the bottom for OEMs. They're going to put out massive volumes across the board, and they're going to compete on price and incentives, which means volumes are going to go up. And just like generators, when your neighbor has them and they're watching TV while you're sitting in the dark during a power outage, you get one the next time. It's the same with new cars. There haven't been a lot of new cars. As your neighbors start to get them, you're going to get them. And with incentives and with rates coming down, Besson's going to bring down that 10-year yield by eliminating some bank charges and deregulation on that front. I think a lot of good things are going to happen with consumer spending, and I think a lot of it is going to be concentrated in the automobile industry because it's needed. 13.5 years is the oldest the fleet has ever been, and we have 72 some odd millennials that need cars, starting new families, moving out to the suburbs, et cetera.
Yeah, that I wonder what that's going to do to the auto industry. Just let us know. We'll move on. Clearing inventory. I just happened to have walked into a Tesla dealership yesterday
Yeah.
while I was waiting for something else, and they told me that they have the inventory prices for their models in inventory, and then they have the tariff prices if you order online. That's going to come in a couple. That's like 20 grand more for every model, which is a big number for Canada. So
Yeah, that sounds like a sales pitch. They won't get away with that because
all right, then.
there's so much supply that's coming on, and then everyone that's worried about, oh, this was a one-time pull forward. Well, they're going to now have to replenish those inventories, and
Okay.
all the manufacturers are going to be doing it, which is going to create a lot of supply and a lot of incentives. So, Tesla, if Tesla believes that, they're going to get a rude awakening call as they bring prices
Okay.
down in coming months.
This is why we should go shopping with Tom Hayes. But Tom, tell us about the FOMC. We're expecting a no action from the FOMC. Well, that's what the markets are expecting for this week. What's happening for the rest of the year? How many rate cuts are we expecting, if any? Are you expecting?
Yeah, it's interesting. We saw last week we saw negative GDP. We saw the PCE come in the lowest it's been, which is the Fed favored number, lowest it's been since November. So those were the two pieces. But what have they been talking about? Waller and the Cleveland governor, they've all been saying we're watching the labor market. So we saw the ADP was weak, and we're like, okay, if the jobs number is weak, the Fed could move, soon. Jobs number was very strong. So it might be a little bit backward looking, but certainly 100% takes May off the table. June is, was at 65% odds. It's probably a little lower now. I'd say June is a coin flip. I still am of the camp we're getting to before the end of the year.
Your overall tone reminds me of Warren Buffett's speech over the weekend when he announced his retirement.
The time has arrived where Greg should become the chief executive officer of the company at year end, and I want to spring that on the directors effectively and then give that as my recommendation.
He said he was very lucky to have been born in America. I'm paraphrasing here, but we should continue to invest in America. And long term, he's very bullish on the prospects of capitalism in America. I'm guessing you largely agree, but how do we make that an investment thesis here?
Yeah, look, Buffett is my hero. I learned so much from him and Charlie over the years. It's shaped a lot of who I am. Obviously, I have my own special sauce, turnaround Tom. I like more turnarounds, more of what Buffett was doing when he was running outside money the first 12 years than what he did during Berkshire. Look, U.S. exceptionalism will never change. And the reason that will never change is because of immigration. I mean, that's fundamentally what it comes down to is we've had the best ideas and the best minds and the risk takers from around the world who took a chance and came to America. And it's this repository of the best of everything in the world in one place, plus natural resources, plus good defense borders. So that's never going to change. Now, does that mean U.S. equities have to outperform because America is so great? No. And if you are willing to look past a little recency bias of the last decade, you'll see that every 10 to 15 years, you run in cycles where dollar is strong and U.S. equities outperform, which is what you've seen in the zero interest rate policy period post-Great Financial Crisis, plus a few extra years. But then if you look back, even during Reagan, there was a big period there that international equities outperformed U.S. Not because U.S. wasn't great, not because Reagan's policies were bad or the rest of the world got better than the U.S. It's just a normal cycle. Some of it has to do with U.S. dollar currency. Some of it has to do with earnings power. But it is a regular cycle every 10 to 15 years. International outperforms U.S., then U.S. outperforms international. And I do think we are on the cusp where we're going into, and have already started actually, a period where international equities outperform. And that could simply be a function of multiples as Mag 7 have been more subdued. and their weighting starts to normalize in the S&P 500, the index's weights and composition may start to look a bit closer to international. And then you've got some earnings growth in some international pockets, which is really exciting, like China tech, et cetera, that could start to take up some of the weight in the international indices and then the institutional flows. And it's a flywheel. As more money goes in, the multiples go up, which creates more flow, which is what the U.S. has benefited from for the last 15 years. And I think we're probably going to moderate relative returns, even though we'll have good returns, we'll moderate relative returns. And I think the outperformers are going to be the ones that have exposure to international in the next 10 years.
That was my next question. If not the U.S. equities, where should we go for outperformance?
Well, look, I talked about Cooper Standard, which was a U.S. company we have a huge position in. We've had a huge position in Alibaba. I mean, and that's been, a couple of years in waiting. Every red day we've been buying stock, and it's now rallied. And we've got a average basis across all accounts of about $83. We think that's just getting started. Now, we've got the problem that you got all these politicians that say, let's torch U.S. investors and delist it and cost U.S. investors $800 billion, which would be the dumbest political move of all time to torch. It doesn't hurt China to delist Chinese companies. It's not Chinese investors that are buying U.S. ADRs. It only hurts U.S. investors. So we've shifted all of our equity exposure to Hong Kong holdings just in case stupid political decisions are made. But we still do own some derivative exposure in the U.S. and we'll just absorb that risk because we can't replicate it in Hong Kong. But the bulk of our allocation is now held in Hong Kong shares just to hedge out that delisting risk, which I think was more acute a couple of years ago when it ultimately came through with flying colors through the PCAOB. And I'm sure this is probably some part of the negotiating leverage with China. Come to the table and do a deal, or we will take away your access to U.S. capital markets. And it's being fostered by a couple of actors like Rick Scott and others who are the headline grabbers for the negotiating leverage with China. But I think when all is said and done, I'd assign maybe it's a lot less than a coin flip odds of delisting. I'd say it's probably 20% because it only hurts us. I think if they really were sincere about it, what they would do is say, we're not going to screw the U.S. investor. What's listed here is going to stay listed here, but we are closing the door to any new offerings in the U.S. prospectively. That would be like a sincere play where I'd be more concerned if that was the case, because that would tell me that they've actually thought it through. It wasn't just an anti-China sentiment. And if they had thought it through and then they cut off capital markets, I mean, all that effectively happens is you take billions of dollars of fees that go to U.S. banks and you push them out to London and you push them out to Hong Kong exchanges, which again hurts the U.S. more than it hurts China. But if that's the direction they take policy, we've hedged, because what they can't do by delisting them is change the earnings power of an Alibaba or a Tencent and the free cash flow they generate and the amount of shares that they buy back. And the number one AI play in the world right now, their Qwen 2.5 is outperforming DeepSeek, it's outperforming ChatGPT, and they own an equity stake in pretty much every AI startup in China because they give them cloud computing services. They're number one in cloud computing in exchange for equity in their companies. So there's a lot of outs, like we like to say in poker, by owning Alibaba. You got the number one toll taker, as the Chinese government wants to move the Chinese economy to 70% consumption over the next 10 years. Alibaba will get 40 cents on every dollar as a toll taker, goes through Alibaba. And a lot of positive things happening. So China, certainly opportunities in beating down Europe, emerging markets, et cetera. So there are a lot of things to do, and there are a lot of things to do in the U.S. If you're not in the indices and you're not in the most crowded trades, there are a lot of companies that are still very undervalued.
Are you ready to meet the biggest minds in Bitcoin face to face? Well, this summer, the crypto capital of the world isn't Silicon Valley or New York or even Miami. It's Las Vegas, introducing Bitcoin Vegas, the ultimate Bitcoin event of 2025. And this is not your average conference. Join real conversations with people shaping the future of money. Thought leaders like Michael Saylor, Lynn Alden, Ross Ulbricht, Winklevoss twins, David Sachs, and many, many more. Whether you're a hodler, builder, or just Bitcoin curious, BTC Vegas is where ideas ignite, partnerships form, and conviction grows in the space. Tickets are going fast, so lock in your spot today using my link down below or scan the QR code here. You'll get a 10% discount. Get it before tickets are sold out completely. We'll see you in Vegas. Are you betting on the Chinese economy when you're investing in Hong Kong equities at all? Are you exposed to Chinese growth? For example, I was reading just now, China's exports rose 6.9% in Q1 2025, despite the ongoing trade wars with the U.S. Chinese officials recently said the sky won't fall for China's exports, especially since they're diverting a lot of their U.S.-bound exports to other countries in Southeast Asia and perhaps domestic consumers. So what's your take on Chinese growth here?
100%. It's a de minimis portion. Like it's almost, I think if the apocalypse happened and there was a U.S. embargo on Chinese goods, I think it would affect Chinese GDP by 1 to 1.5%. So, they've kind of been preparing for this, number one. Number two, they already devalued the yuan by like 20%. So it's like, oh, you want to tariff us 20%? We've already priced that in. So thank you very much. If you want to do a deal, we'll appreciate the yuan. So it's kind of silly season. And I understand why they're doing it. And by the way, there's a deal to be done because the U.S., if you look at the percentage of manufacturing versus consumption in China versus the percentage of manufacturing versus consumption in the U.S., it's like a 20-point spread. And they just basically want to meet in the middle. If we got 10 more points of manufacturing and they got 10 more points of consumption, it's a win for both countries. So they're going to do a deal. There's probably no delisting. If they don't do a deal, it hurts their GDP 1.5%, and they'll just amp up the stimulus, which helps companies like Alibaba. Am I making a bet on China, China's economy? Implicitly, yes, but Alibaba got so undervalued as a sum of the parts. I mean, between the number one cloud provider, number one retailer to the middle class. So as their economy is recovering and the stimulus is kicked in, they're just so the demand for compute power and AI and everything going on with Alibaba, there's just nothing like it in the world where price is what you pay, value is what you get, quoting Warren Buffett, that you could have done this. And yeah, it's up a bunch from where we own it, but I think it's just getting started. So irrespective of whether they do a good deal or a bad deal, obviously I'd prefer a good deal that makes sense for both parties. And I think President Trump wants a good deal for both parties. He's more of a pragmatist than an idealist, and that's started to come out in recent weeks. But if you read all his books, he always starts with punch you in the face first and then offer you an ice pack. And that's how he gets to a final deal. So...
All right. Well, so Hong Kong equities, what about other asset classes? Are you diversified across other asset classes outside of equities as a hedge?
We're an equity manager. So we run a concentrated equity portfolio with derivative overlay for family offices and ultra high net worth individuals.
I see.
So
I guess not.
So the answer is no. But I could see a scenario where... So we would express it through equities. Materials have been left for dead. I think there are some commodity plays to be had. We have had a view when it was unpopular that the dollar was going to continue to weaken. Now that everyone is kind of in that boat, we probably get a counter trend bounce in the short term and then resume the intermediate downtrend a few months out. But, when you see it on the cover of The Economist and Barron's at end of the dollar, it's like, all right, so now we're going to get a bounce. So I definitely like materials. I like some commodity plays. I'm trying to figure out how to get more exposure to energy. We've got a big position in Comstock Resources from just below $9. It's up a lot. It's a natural gas play on the Haynesville. Jerry Jones, the owner of the Cowboys, owns 66% of that. So we're trying to figure out maybe oil servicers, try not to play the price of oil, but just the volume, kind of like what we did with the auto industry. We don't want to be in the OEMs, the car manufacturers. We want to be in the arms dealers, the suppliers, let the car manufacturers duke it out, race to the bottom in terms of margins, and let the suppliers benefit from volume. I think that's going to be the case with, natural gas is a covert play on AI demand. And compute demand running the data centers. We need unlimited amounts of energy, and I think natural gas is going to be the transition. So there's a lot to do there as well.
Interesting. Final question, since you brought up what people are feeling, what is the prevailing sentiment in the equities markets right now? We've had a bit of a rebound, as I mentioned in the beginning. We talked about this. Is it still one of fear and uncertainty, or are people a little more bullish now in May?
If you look at the sentiment indicators and you look at the positioning, yes, VIX has come down. Yes, you've had the breadth thrust. I think people are still skeptical, and I think there are a lot of bears that are angry and are praying to God that they see a retest of the lows. And my guess is we'll get a couple of deals and maybe consolidate. Get a few percent pullback in coming weeks, and the bears will think that they're on track, and it's going to go back and retest, and then we push higher and higher because the earnings and the guidance, I mean, the fact that we can have this level of guidance and still looking at $302 of earnings in 2026, despite knowing all of this chaos, is telling me that, God forbid we get any good news, the pent-up demand. I mean, I see it and feel it just in my daily life at the restaurants, at, shopping, at the malls, et cetera, travel. I mean, people don't seem to have a care in the world from what I can see. I certainly hear it in the conference calls at the very lower end. There is some strain, et cetera, and we understand that. But to circle back, people still have jobs, and when people have jobs in America, they tend to spend.
Excellent. Well, let's see what happens later in the year. Your track record on my show has been pretty impeccable so far. So if you're bullish, then we should probably look at that as a signal. I'm just wondering whether or not, to my previous question, I'm just wondering whether or not there was a strong sentiment that we can play as a counter trend, but it seems like people are kind of on the fence right now. Yeah.
I think, the extreme that was a no-brainer was in early April. And we were kind of identifying that on our podcast. I think at this point, the bears know they're screwed, so they're just praying for a second bite at the apple to be able to buy at new lows. And the bulls that, usually what happens is everyone probably bought up on Thursday and Friday after 8-9 days up. And so those people need to get punished. So my guess is you'll see some short-term volatility in the coming weeks, maybe a few percent pullback just to hurt the Johnny-come-latelys. And then when the bears think they're back in control, we rip higher. And that would be consistent with what we saw in the 2018 recovery in Trump 1.0. So look, those are best guesses. I mean, at the end of the day, I just like to look at companies, and what I did on I did a call on April 7th for my clients, and we went through company by company, just the free cash flow and the balance sheet. And we're like, look, the worst case scenario can happen. These things are priced for that. And if you get any possible good news, we're going to have the most incredible few months we've ever seen. And that's been the case in the last few weeks. It's been insane to the upside. And fortunately, I have really incredibly smart clients who were sending in a ton of money at the lows to buy stocks versus the opposite. So very grateful on that front. And, we take it week by week. As the facts change, we adjust our viewpoint. But on balance, what we said in the beginning of the year, I think is going to hold true. I like the high single digits upside for the S&P 500, and maybe a little more if we get a lot of good news. But it'll be some bumps between now and then to get there, and just use those as opportunities.
All right, perfect. Thank you. Where can we follow you, Thomas?
On X, Twitter, I'm at Hedge Fund Tips. On TikTok, a huge following at Official Hedge Fund Tips. Same on Instagram at Official Hedge Fund Tips. And then our podcast is Hedge Fund Tips with Tom Hayes. It's number one in the hedge fund category. You can find it on YouTube or anywhere you get your podcasts.
Okay, excellent. We'll put the links down below, so check that out. Thomas has an excellent podcast. Take a listen. So we'll speak again next time. See you. Take
Thanks
care.
so much, David.
Thank you for watching. Don't forget to like and subscribe.